All right, in this explainer, we are diving deep into the massive collision between a truly world-changing vision for Bitcoin and the absolutely brutal reality of what's happening to MicroStrategy's stock chart. We're going to break down the grand thesis, the staggering price drop, and a really interesting theory that suggests this might all be happening for a very specific reason.
So let's just start right here with the core idea that drives everything for MicroStrategy. And look, this quote from Michael Saylor, it's not just some snappy one-liner. It is a deep, fundamental belief that Bitcoin is the ultimate, final form of money, and it's here to challenge the entire global financial system.
Okay, so to really get what's going on with MicroStrategy, you first have to understand Saylor's grand vision. And it's an audacious one, for sure. It all kicks off with a really simple but powerful premise. Investors are fleeing risk.
And he's talking about a very specific kind of risk here, counterparty risk. I mean, think about it. When you put your money in a bank or buy a stock, you don't actually hold the thing itself, right? What you hold is a promise from that institution. Saylor's whole point is that people are waking up to the fact that those promises can be broken.
And all that anxiety, it's creating this massive global hunger for something totally different, a bearer asset. That's an asset you can hold and control yourself, with zero counterparty. No one else's promises are involved. It's a pure store of value, completely outside the traditional system.
Now this is where it gets really interesting. For centuries, gold has been the world's go-to bearer asset, so we know the demand is real. But Saylor's argument is that Bitcoin is simply the technologically superior version. It's not heavy and hard to ship. You can, as he puts it, teleport it anywhere in the world. It's instantly verifiable, and you can program it in ways that are just impossible with gold.
So because of all these tech advantages, you get this absolutely colossal prediction. The source analysis points out that Saylor isn't just saying Bitcoin will match gold's multi-trillion-dollar market cap. No, he's betting it's going to be 10 times bigger, which would just completely rewrite the map of global wealth.
All right, so you've got this incredible grand vision of the stock eventually going into the thousands. But then you look at the chart right now, and what do you see? Oof, it's just brutal. Let's dig into how this amazing story stacks up against the painful truth of today's price.
I mean, just look at this number. We're talking about a drop of nearly 65% from its recent high. That is the kind of drop that doesn't just hurt, it shakes your conviction to the core and makes you question the entire thesis.
And it's not just falling randomly, it's hammering on the absolute floor. The source material calls this the line in the sand. This is the 52-week low, and it is a massive, critical support level where an epic battle between buyers and sellers is playing out right now.
So how can both of these things be true at the same time? You've got this incredible long-term story, but the short-term chart is a disaster. Well, the analysis we're looking at points to this really interesting technical idea called the rubber band theory, or what some call a spring load setup.
And this chart right here, it shows you exactly what we're talking about. The current price, which is down around $158, is stretched incredibly far away from its long-term average. That's the 200-day moving average, sitting way up at $322. That isn't just a gap, it's a giant chasm. So what does that mean? Well, the theory goes that when the price gets stretched this far, like a rubber band, a violent snap back becomes not just possible, but likely. You know, just getting back to its long-term average, just a return to normal, would mean a gain of over 100% from where it is right now.
And you know what? There are actually some subtle clues that the people panic selling are starting to run out of gas. The analysis points to a recent attempt to really flush the price down, but it failed. The price just refused to break that key support level, which suggests the sellers are, as the source puts it, running out of ammo.
But what if this isn't just random selling? What if this is all happening by design? The source we're looking at suggests a very different story, that this could be a deliberate, engineered shakeout designed specifically to get shares out of the hands of everyday retail investors.
It's like a four-step playbook. First, you hear the media hyping up how safe and successful gold is, which makes crypto investors nervous. Then, market makers start pushing the price down, aiming straight for that critical low point. This triggers a cascade of automatic stop-loss orders from retail investors. And who's just sitting there waiting to buy up all those shares on the cheap? The so-called smart money.
And the analysis doesn't pull any punches here. It's blunt. This entire painful process is engineered for one simple reason, so that sophisticated players can accumulate your shares at a deep discount.
Okay, so let's pull all these threads together. You've got two completely different timelines clashing. The epic long-term vision versus the painful short-term panic. Let's see how the source material breaks down the different ways this could play out and the key price targets you've got to watch.
This table lays it all out perfectly. The bear case is simple. If that $154 support level breaks, well, we could see even more pain. But the bull case has multiple levels. In the short term, you're looking for a technical bounce back to the 50-day average around $213. Medium term, that snapback we talked about, a 100% jump to the 200-day average. And then there's the long game. If Saylor's whole thesis plays out, the price could be deep into the thousands.
Which leaves us with this final kind of provocative question. If the long-term destination really is a world where Bitcoin is 10 times bigger than gold, and MicroStrategy stock actually reflects that, then is all of this painful short-term volatility simply the cost of admission?